option jive. Let's take a look. We're running a little bit behind today, so we'll try to catch up. And we'll see. What's Zoom doing?
Zoom golly down around $2, I think.
Down $2?
$1.20.
Oof.
Half of that.
God. It's funny. When you put big positions on Zoom, it goes up $200. When you put like crappy little positions
Sold
on.
both sides. Thank you, Bat. Appreciate that. You're welcome.
When you put crappy little positions on, stock does exactly what you want it to do.
Size kills. Always
size kills. Theta decay versus negative gamma. Don't worry, we don't go too heavy into the Greeks, but just a little test this morning.
Scratch the surface?
Yeah, we're going to scratch the surface. You hear us talk about gamma risk a lot, and every once in a while you read about it in the papers, especially when there's like crazy, like meme stock stuff, and people talk about, oh my God, a gamma risk. Gamma is one of the four main...
Gamma risk is a clickbait.
It's a little clicky.
Argument.
Yeah. Gamma is one of the four main option Greeks that is usually the least understood. Unlike the other three Greeks, Delta, Theta, and Vega, gamma is, I have so many things to say about that. Gamma is not intuitive. So today we will explain what it is by comparing it to the commonly understood Greek Theta, which is just the number that we kind of watch on our portfolio. We don't have a column for, we don't display as a default the column for gamma, but we do display the column for Theta because we always kind of want to know what our daily decay is. Mm-hmm. How much money am I going to collect today, or should I collect, in a theoretical sense? And same thing for Delta, Vega, and Gamma. Yeah, we don't watch those the same way. We don't have to be that granular. Let's go next slide. So the risk over a course of a trade is different depending on whether you buy or sell premium. Theta represents the cost over time if nothing happens to the stock, while Gamma represents the risk if the stock makes a big move. So most of us are short premium. We'll look at the last line. So it says position, short premium. So what do you want? You don't want a big move. And what are you risking? You're risking your gamma. Now, if you buy premium, you want a big move, and what are you risking is Theta. But we're at risk for gamma, which is what happens if there's a big move. Let's go next slide. So gamma is to short premium as Theta is to long premium. Premium sellers receive Theta in exchange for taking gamma risk, while premium buyers take the other side of the trade. Such a beautiful marketplace. Premium sellers receive Theta. It's the money you get paid. That's all that juice that you're collecting in exchange for taking risk of a big move. And again, we look at that last line where it says short premium, and your gamma position, you're always negative gamma, and your Theta position, you're always positive. And for the last 11 years, every single day, our Theta position has been positive. And for the last 11 years on Tasty, or 12 years on Tasty, our gamma position has always been negative. We are negative gamma, we are positive Theta. Harumph.
That's just the facts, Jack.
Those are the facts. Let's go to the next slide. The actual gamma and Theta numbers are not as important as recognizing that they always change in tandem, higher or lower. So the argument from our research team is, listen, it doesn't matter what the actual number is. What matters is the fact that when one moves, the other moves. And as you can see here, the closer you get to expiration, and this is why there's so much more risk, your gamma numbers go up 8-fold when you go from 45 days to 1 day. And so, and your Theta numbers only go up 3-fold. But that's kind of some of the risk of getting down towards, the very short expiration. It's harder to control the positions. Mm-hmm. And here's an example, but they move together. That's the takeaway. They always change in tandem, both higher or lower. So if your gamma goes up as you get close to expiration, your Theta numbers go up. And so when we roll to 45 days to expiration and we're looking at our position and we go, wow, our Theta numbers, let's just say our Theta number is $1,000, okay? By the end of expiration, if you held it all the way to the end, it's gonna be like 3,000. But if you hold it to just like maybe 21 days, maybe it only goes up to, see 21 days here, maybe it only goes up from 1,000 to 1,300.
Yeah.
That's the difference.
Yep.
Let's go to the next slide. So being closer to expiration, and this is something that most people don't get, and this is why we manage early, but being closer to expiration is the most impactful variable to the level of theta and gamma. But another variable is the closeness to at the money. Further out of the money options have lower theta and lower gamma. So we tend to do, not at the money, but we tend to go to about the 16 to 25 delta, 22 delta, 20 delta, whatever it is, far enough out of the money and long enough away from, with a long enough duration, so that if we're wrong, our position is easily manageable. Again, being closer to expiration is the most impactful variable to the level of theta and gamma. And another one is closeness to at the money. So you want to give yourself the best chance for success. So you move away from the at the money significantly.
Gives you a higher probability.
And you
of
go
success.
long as you can. Well, not long as you can, but long as you can inside the sweet spot. So
But as long as you can, you mean furthest out?
furthest
Or
out, longest duration. That's reasonable. And you can see here,
What would be reasonable to you? Like 60-ish days would be a max?
45 days. That's what
Well,
our
that would
research
be
says.
optimal, but-
Well, that's what our research says.
Yeah.
So high or low gamma and theta. And in this case, we want to be further out in time and further out of the money. Keep those numbers low. Low, 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 low. Let's go next slide. So the takeaway slide, and this is like a real simple way to look at theta and gamma. They move together. Theta and gamma represent the theoretical risk and reward in the option world. Both will always move together in an efficient market. And gamma is what we risk as premium sellers. The highest gamma occurs for the at-the-money options, but the most impactful variable is the closest to expiration in DTE.
And gamma's the amount of movement that the option's going to have, right? I mean, the
Yeah,
delta.
remember, zero DTE, we did this the other day, zero DTE has 100 times the risk of 45 DTE. 100 times.
Big.
That's right.
Let's take a quick 90-second break and come back. We got more Tasty Live after this. We got opening bell. Back in 90 seconds.